Well, hello and welcome to another Cats & Co video. Now, following the last video where I commented on what a currency reset might look like in practice, people have increasingly been asking me how assets like gold, Bitcoin, cash, property and pensions might fare, and in particular, which would prove most resilient. Now, there are good reasons why gold and Bitcoin usually come up first. People are looking for something that survives if the monetary system itself changes. Because if there is a reset coming, and I do think at some point there will be, then this really isn't just about returns anymore. It's about what needs permission and what doesn't. So let's start with gold. Physical gold that you actually possess sits in a very particular category. It doesn't rely on banks. It doesn't rely on networks. It doesn't need conversion. It doesn't sit on anybody else's balance sheet. And that is why gold keeps reappearing at moments of monetary change. Not because it's exciting, but because it's boring and difficult to interfere with. Now, yes, I know gold has been restricted, for example, in the United States in the 1930s, but I do think that today that would be politically explosive. Gold works because it bridges the system. Now, Bitcoin solves a similar problem, but in a different way. It's self-custodied, easily stored, easily transferred, and it is highly fungible. Technically, it is very resilient. Politically, I do think it's a little more fragile. So while it's gaining adoption, it is still relatively new, and governments are still working out how to deal with it, which does create a degree of regulatory risk. Now, Bitcoin is kind of a global technology living inside national politics. There's a practical difference between the two. Gold is excellent at storing value and is difficult to track, but it's heavy, physical, and difficult to move quietly across borders. Now, Bitcoin, by contrast, is almost frictionless to move. However, it is trackable, and that makes it risky in jurisdictions that prohibit it, but extremely useful for people who are prepared to move themselves across borders and political systems to protect their own freedoms. So it's not all about which is better, it's about what problem you're actually trying to solve. Both sit outside the traditional monetary system and are resilient in different ways. Now, contrast that with cash. In a world moving towards central bank digital currencies, paper cash risks becoming instantly defunct. Cash only works inside a cash system. Once a mandatory digital currency exists, then the cash doesn't need to be confiscated to become irrelevant. So cash is not resilient. Real estate, I think, sits somewhere in between. Property is visible, immobile, and easy to tax. But having somewhere to live clearly matters. Shelter itself has real utility, and more rural and self-sufficient property tends to have an even stronger resilience profile. And that's why we see planners, people thinking a few moves ahead, gravitating toward property with some degree of independence. Not because they necessarily expect collapse, although some of them do, but because utility matters more than optimization in uncertain times. And this is also where jurisdiction starts to matter. Property doesn't exist in a vacuum. Islands, in particular, do tend to attract people during periods of uncertainty, not because the islands are perfect, but because smaller jurisdictions often have clearer rules, kind of a tighter social contract, and more predictable responses under stress. So, is property resilient? Well, partially. It doesn't disappear in a reset, but it is immovable and taxable, which means it sits inside the system. It survives because it's useful, not because it's sovereign. Owning a home gives stability, but it doesn't give control over the rules. Now, stocks and shares. They sit fully inside the system because they're priced in most likely legacy currency, and you need brokers, exchanges, settlement layers, and eventually CBDC rails. They don't opt you out of anything. In one sense, they opt you in more deeply. That doesn't make them bad, but it does mean that they will be reshaped however the new system requires. And this is where the reset logic really comes together. I don't think the old money simply gets wiped out, but I don't think it will be honoured in full either. I think old assets, old promises, pension funds, legacy savings and so on, get converted at the same time a new currency system is introduced, but in layers. And this is where the universal basic income, or something very close to it, may also come into the equation. The delayed conversion of legacy assets, potentially, as I say, including pensions and large bank balances, investment accounts, could form the basis of some sort of UBI-style income floor. That floor will placate the masses, while legacy claims will be capped and tapered. So smaller pensions will be largely protected, larger ones will be partially honoured, and the very largest quietly written down. A covert confiscation reframed as sustainability and fairness. And that's the real fault line. If your wealth exists only as legacy assets, as promises inside the system, then the system will decide how and whether they are converted. Assets that don't need conversion, gold, bearer assets, and self-custodied assets like Bitcoin, don't face that negotiation at all. So for people with little capital, the reset will feel like support. For people with savings, it will feel like expropriation. Slow, procedural, but entirely legal. So this is why I think we're seeing people rebalancing their assets now, while they still have choice and agency to do so. In theory, all assets are equal, but in a reset, some assets are very clearly more equal than others. Well, I hope you found that interesting. If you did, please like and subscribe. I'd also be very interested to hear your comments in the comment section below. So until next time, thank you very much.